Good afternoon. Me, Dr. Gagan Singh from Uttarakhand Open University. Today, the topic which I am going to discuss with you, that is tax saving options and return e-filing. In earlier, you have learned about the various finance planning and borrowing options which is available to an investor. But today we are going to discuss in detail about what is tax and what are the various types of tax and what do we mean by taxable income, what is exemption and deductions, and what do we mean by financial year and assessment year. Then we have tax saving options available. Then we have e-filing of income tax return. Then what are the various type of ITR forms we will going to discuss in detail. Then we have the steps to e-file ITR, how we can file ITR through electronic mode. Then we have the important documents for ITR filing and benefits of e-filing. So this is all about the today discussions. So let's start with what is tax. As you know that tax basically is a mandatory financial charge or levy imposed by government on individual, businesses or other entities to fund public expenditure. This is the basic definitions of tax. Tax are what are the purpose for which tax are used, that are healthcare is one. Then we have the education, the money collected through tax we can spend on healthcare by the government on healthcare education sector is there. Then we have the public infrastructure in which we have roads and bridges. Then we have the national defense and social program. There are so many social welfare program where government spend the money collected through tax. Now the question, why we pay tax? As I told you in the previous slides, first purpose is to fund government operations. So many government operations, as I told you, healthcare, education, social welfare is one of them. To build and maintain infrastructures, as you know, infrastructure required heavy investment. So tax is one of the source. Then we have to provide public services, as I told you, education and policing and healthcare. These are the areas where government spend the money collected through tax. Then we have the redistribute wealth and support the vulnerable. How we can redistribute the wealth to achieve the goal of social equity. Then we have the types of tax. I am going to touch these area in very brief, so you have some idea about before filing or filing the ITR, and before knowing about the various saving tax saving options, you must have knowledge about what do we mean by tax and what are the various types of tax. First one, income tax. As you know that as far as the types of tax are concerned, we have direct tax and indirect tax. We will discuss in detail. Income tax, that is charged on what individual or companies earn, that is covered under income tax. Sales tax, added to the price or goods and service as the point of sale. Then we have the property tax, based on the value of land and building. Corporate tax is there, levied on company profits. Excise tax, value added, and GST. As far as the direct tax is concerned, what do we mean by direct tax? These are the taxes. Basically, these are the taxes that are directly paid by the individual. When the burden of the tax is directly borne by the individual or organization to the government, the burden of tax cannot be shifted to someone. In this case, no one can shift the burden of tax to another. And what are the various types covered under these direct taxes? One of them is income tax. Then we have the corporate tax. Then we have the capital gain, wealth tax, and various as security transactions tax. So all these taxes covered under the category of direct tax. Then we have indirect tax. Indirect tax, what do we mean by indirect tax? Basically, these are taxes that are levied on goods and services, and the burden of tax is passed on to the final consumer. Basically, it is collected by the seller, or when you can say seller, those who provide these services to the customer, and finally the burden of tax is passed to the final consumer, that is known as indirect taxes. The seller collects the tax and pays it to the government. Basically, it collects by the seller and finally pay to the government, but the burden of this tax comes under shifted to the ultimate consumer. So as far as the various tax covered under these categories, GST is one of them. Then we have the custom duty. Then we have other tax, service tax charged rate by GST. So all these taxes covered under the category of indirect tax. Indirect tax, as you know, that custom duty means tax on imports and export. Basically it is collected by another person, and finally the burden is shifted to the consumer. So all these taxes known as the indirect tax. Now what do we mean by taxable income? These are the basic terms which you must know about before knowing about the various options, tax saving option, and before knowing the how to file the ITR, ITR. Now what is taxable income? Taxable income basically is the portion of your total income that is subject to income tax, where we actually calculate the tax after allowing for exemption, deductions and rebates as per the Income Tax Act. As far in case of formula, you can see on the screen that taxable income is what? Gross total income, which is the total of all types of incomes, minus deductions under chapter 6A. All these deductions, when we deduct from the gross total income, then it comes the figure comes that is known as taxable income. Now how we can calculate the taxable income? First component of gross total income, as I told you, there are so many heads in this area. First one is income from salary. For example, the basic salary, HRA and bonus if you get from your employer. Then we have the income from house property. For example, rent received from a house or a flat, that comes under the category of income from house property. Then we have profit and gains from business or profession. For example, income from businesses and freelancing. These incomes come under the category of profit and gains from businesses. Then we have the capital gains. For example, profit from sale of property and shares. All these incomes or profit comes under the category of capital gains. Then we have income from other sources. For example, we have interest on savings and lottery income. All these comes under the category of income from other sources. These are the component of gross total income. Then when we calculate the gross total income and we deduct deduction chapter 6A, as I told you, then we have the under section like we have ATC, ATD, ATG, ATE, AT, TTA. All these ATC cover the PPF, LIC, ELSS, etc. And ATD deals with the health insurance and ATG with the donations. As you know that tax is calculated only on the taxable. Why we are discussing this? You must know about the on which figure we calculate the tax. This taxable income, where we calculated the tax, not on the total earnings. Proper tax planning help. Proper tax planning helps in reducing taxable income and save money legally, because legally when we save the money, the legal concept must be there. Then we have the exemptions and deductions. What do we mean by exemptions and deductions? As you know, these are the very common term while we calculate the income tax. Exemptions is what? Exemptions are certain types of income that are completely or partially not included in your total income for tax purpose. This is known as exemptions, which is not included either it completely or partially. Think of it as income not taxable at all. Why? Exemptions are subtracted before arriving at gross total income. What are the various type of exemptions? For example, we have the HRA, house rent allowances. It covered under section 10(13)(a). Then we have the leave travel allowances is there. Agricultural income is there, that comes under the category of under the section 10(1). Dividend income, we have income from gratuity. It covered under the section 10(10). So all these are the example of exemptions. Then we have the deductions. What do we mean by deductions? Deductions are specific amounts that reduce your taxable income when you invest. When you invest your money somewhere at various sources which is defined under the Income Tax Act, it helps to reduce your taxable income in order to save the tax, and spend or donate as per the rules. As think of it is what do mean by allowed reduction in taxable income. This is known as deductions. Deductions are subtracted from gross total income to get taxable income. This is the step when we calculate the taxable income. As far as the example is concerned, we have the PPF, LIC, ELSS that comes under the category of section 80C. These covered under the category of deductions. Then we have the health insurance premium under section D. Then education loan interest, section 80E, deductions to charities 80G, savings account interest of 10,000 that comes under the category of section 80 TTA. All these come under the category of deduction. Then we have, after exemption and deductions, we have what do we mean by financial year versus assessment year. Financial year is what? The financial year is the year in which you basically earn the income. This is the year when you earn the income. It starts on 1st April and ends on 31st March of the following year. This is the definition of financial year. You make investment, earn salary, business income, pay tax, etc. in this period. Whatever you earn, whatever you invest, they comes under financial year. Example, if you earn income from 1st April 2024 to 31st March 2025, it is called your financial year, that is 2024 and 25. This is your financial year. Then assessment year. The assessment year is what? Assessment year is the year in which your income of the previous financial year is assessed, examined and taxed by the income tax department. So this is the definition of assessment year. It comes immediately after the financial year. As I told you, for financial year, if the financial year is 2024-25, then the assessment year will be 2025 to 26. You file your income tax return in the assessment year. This is the basic difference between the financial year and assessment year. Then we have what do we mean by tax saving? What the basic definition of tax saving is: tax saving means using legal provision. I am stressing on this point that legal provisions, you have to follow the legal provision under the Income Tax Act to reduce your taxable income, thereby paying less tax. This activity and process why we do in order to pay the less tax. Then we have, there are various deductions, exemptions and investment instruments that help save tax. As in previous slides I have already discussed about the deduction, exemption, and in the coming slides we are going to discuss about the various investment instruments we have available to save tax. Now we are going to discuss in detail about the various tax saving options, primarily under old regime. As you know that new regime is also come under consideration, and majority of the taxpayer are using this. So this is the preview of old regime. What happened in old review? Section 80C, maximum deductions rupees 1.5 lakh. This is the maximum amount decided by the Income Tax Act under section 80C. What are the various components covered under this section? Life insurance premium, self, spouse or children. PPF means public provident fund is also covered under this category. Then we have the ELSS, equity linked savings scheme. Then we have the NSC, national savings certificate is there. 5-year bank fixed deposit is there. Then we have the EPF, employee provident fund is there. Then we have the tuition fees for children is also covered under this category. And finally we have the principal repayment on home loans. All these comes under the category of section 80C. Now in 80D, as you know, in health insurance premium, self plus family, it is decided by the government, that is rupees 25,000 is the maximum limit decided by the Income Tax Act. Then for parents and for senior citizen, this limit is up to rupees 50,000. Then we have the section 80E, with which component it deals with? It deals with the interest on educational loan. As you know, there is no upper limit, but only for 8 years. Then we have the section 80G. 80G is what? Donation to charities, trust. In this case, either 50% or 100% deduction depending on type. what type of deduction you are or charities you are using, it depend on that, and then the limit may be 50% or maybe 100%. In other tax saving tools, what are available? In we have NPS, National Pension Scheme. This is the new component after national introduction of NPS. It amount is rupees 50,000. Additional deduction under section 80 CCD within bracket 1B. You must know about which section it deals with the NPS. Then we have the HRA, house rent allowance exemption is there. Standard deduction for salaried employees 50,000. In the recent finance assessment year, this limit is increased. Then we have the tax saving option. Now I am giving in a brief idea about financial year 2024 and 25. What is the actual situation? Standard under section 80C, it is 1.5 lakh is there, in which as I already told you, covered investment in PPF, ELS, mutual fund. Section D deals with insurance, 25,000 for individual and 50 for senior citizen. Then it cover health insurance premium for self, family and parents. 80 section CCD IB, additional 50,000 reduction for NPS contribution. Section 20B, income on home loan up to 2 lakh for self occupied property. So this is all about the tax saving option in financial year 2025. HRA exemption, if you live in rented accommodation and receive HRA, it covers under this category. Education loan, I already told you, no cap or deduction for interest paid, and donations which covered under section 80G, contribution to eligible charities. Under the new tax regime, you must know, under the new tax regime most deductions are not available, but the tax slabs are lower. This is the basic difference between the old and new regime, and you can switch between regime annually if you are salaried. This is very important. If you are salaried person, then you can switch between these regime, either old to new, new to old. So this is in detail about the various tax saving options we have available. Thank you and wish you happy learning.